The South African Reserve Bank has made an emergency interest rate cut, and the bank cutting a borrowing cost by 100 basis points, reducing the rate to 4.25%. And this is the second rate cut of 100 basis points this year after the South African Reserve Bank lowered interest rates in March. It marks another move by the bank to absorb the effects on the economy of the spread of COVID-19. May's monetary policy meeting was originally scheduled for next week, but the bank has decided to make the emergency move. So the Reserve Bank's decision to cut the repo rate by 100 basis points has received mixed reaction. While some welcome it, others are left in limbo. And according to analysts, the Reserve Bank rate cut is good for debt holders, but bad for income earners. And people who are on pension and are getting income from bond and money market rates are in trouble. And also people who are investing money in the money market are in trouble as well, as they are already on sub-inflation rates. So let's get an explanation of what this means from Owen Nkomo, who is Chief Investment Officer of Inkunzi Investments. A very good afternoon to you, Owen. Well, some say the Reserve Bank rate cut is good for debt holders. Is this cut good or just like a taste of sugar while the body is in pain?
Thank you for having me, and I think it's welcome for the country's embrace. It's good for corporate South Africa. Small companies that are in debt are going to be able to continue to service their debts. Individuals are going to continue to service their debt at lower cost, as you have said. We've been doing some numbers, and given the past 100 basis points cuts, people have got a bit of money back in their pockets again, and I think that is great. But the other side of the coin says that if you are earning an income from a bucket of investments that are biased towards the money market and cash investments, and to an extent some of the bonds out there, you have the challenge that says the money you are earning, obviously, as interest rates come down, the money you are earning as well is also declining. And that is a challenge that people need to also think about. The money that you have left in the bank potentially is earning you 2% to 2.5% if you are lucky. And importantly, in the big fight against inflation, if you recall that inflation is at about 4.5%, and with the weakening rand, potentially there might be a slight increase on inflation. It means what you are earning relative to what inflation is taking away from you means the interest rates are potentially negative. The real interest rates that people survive on are now negative.
So what do you make out of the market reaction today in this time of volatility? What has been your observation? Are people headed for the safe havens?
Look, what has happened is that the interest rates market has certainly reacted, obviously, to adjust for the 100 basis points cuts. The bond market has reacted. The money market has reacted. And the challenge is, Colin, you're in an environment where people were taking money out of stock market, that money into cash equity markets, or rather into cash markets, instruments such as deposits in the bank and leaving money in your bank, as opposed to having been investing in the stock market. But now all of a sudden, the interest rate cuts mean that people are now having to think twice about what decision they make regarding their investments. Because, if we continue to see interest rates declining, it means the real interest income that people are going to earn is negative. And frankly speaking, there isn't that many safe haven assets out there. But we've seen people piling into gold over the past few days, with the price of gold now trading above 1,700, which is something that only the big investors are able to do with ease. The man in the street doesn't have access to that luxury at this stage.
All right, so now let's get a perspective of the current relief for consumers, and like the interpretation of this analogy, that is this a temporary relief but a future burden for some in the economy?
No, look, I think we need to put things into context. Given the short-term requirements of the economy, given the short-term requirements of the consumer, given the short-term requirements of corporate South Africa, and the short-term and immediate-term concerns of the government, where they're trying to get the economy running again. I think this is the right decision that has been made. It has worked in America. Reducing interest rates has certainly worked, and I think it lives to be seen in South Africa if this current combination of Reserve Bank activities, you know, where they've intervened in the money market or rather through the monetary policy instruments, as well as, you know, some of the fiscal